Most investors are convinced that the rally in gold and silver is driven by simple greed. They think it's just another speculative bubble fueled by retail hype. They are wrong. The truth is far more brutal, and it's hidden in plain sight within the data from the Federal Reserve. We are not witnessing a speculative fever dream. We are witnessing a defensive reaction to a fundamental failure of our monetary system. When real interest rates, that is, your return after inflation, collapse into negative territory, you are no longer playing a game of investment. You are playing a game of survival. You are trapped in a real interest rate trap, a structural mechanism that is quietly dismantling your purchasing power. Most people will ignore the warning signs until their wealth is eroded, until their savings are no longer savings, but a rapidly depreciating asset. Today, we are going to strip away the headlines, look at the cold, hard numbers, and show you exactly why this trend is not just temporary. It is an inevitable, crushing reality that most people are still completely unprepared for. To understand why your wealth is being silently dismantled, we have to look at the math that Wall Street rarely explains in simple terms. It comes down to one fundamental equation: real interest rates. It is the nominal interest rate, the rate you see on your bank statement, minus the inflation rate. That is it. That is the heartbeat of the global economy. For decades, we have been conditioned to believe that as long as interest rates are rising, our money is safe. But that is a dangerous fallacy. Because when inflation outpaces those nominal rates, your real return turns negative. This is what we call the real interest rate trap. And right now, the trap is snapping shut. Think about the position the Federal Reserve is today. They are walking a razor-thin line. To fight inflation, economic theory dictates they should raise interest rates. They should make borrowing expensive. They should drain liquidity from the system. But here's the problem. The United States is buried under an unprecedented mountain of sovereign debt. If the Fed pushes nominal interest rates high enough to actually beat inflation, if they truly try to create a positive real return, they would trigger a catastrophic debt service crisis. The interest payments on the national debt alone would cannibalize the entire federal budget. They would effectively bankrupt the government they are supposed to be protecting. The Fed is effectively paralyzed. They cannot raise rates high enough to kill inflation without killing the banking system, and they cannot lower rates fast enough to save the economy without igniting hyperinflationary pressures. They are trapped in a debt spiral where the only way to manage the situation is to keep real interest rates in the negative. This is not speculation, it is a mathematical necessity of a debt-saturated system. And when you realize that, the current price action in gold and silver starts to make perfect sense. History has seen this play out before. Look back to the 1970s. It was the last great era of the real interest rate trap. During that decade, the inflation rate frequently sprinted ahead of the Fed's nominal interest rates. Throughout that entire period, the dollar was losing its purchasing power faster than the bank was paying you to hold it. Investors during the 1970s learned the hard way that when the government is forced to keep real rates negative to survive, paper assets become a liability. You had people desperately holding on to cash, watching their savings buy less bread, less gas, and less security every single month. But those who understood the trap, those who moved into hard assets like gold and silver, did not just survive, they thrived. The 1970s proved that gold and silver are not just investments that you buy to get rich. They are the ultimate insurance policy against the math of a failing monetary system. But here's where things get dangerous for the modern investor. We are now seeing a scenario where the structural debt load is significantly higher than it was 50 years ago. The tools available to the Federal Reserve are fewer, and the consequences of a mistake are far more severe. We are in a regime of financial repression. This is a policy where governments intentionally keep interest rates below inflation to slowly inflate away the value of their own debt. They are essentially taxing your savings through the back door. They are siphoning value out of your bank account and transferring it into the treasury. Most people are still looking at their brokerage accounts and feeling a false sense of security. They see the nominal numbers going up and they feel wealthy, but they are failing to account for the hidden tax of inflation.
When you factor in the true cost of living, their real wealth is declining. This is why the precious metals market has been consolidating for 17 weeks. It is not because the fundamentals have changed. It is because the market is waiting. It is waiting for the realization to sink in that there is no soft landing. There is no miracle solution where the Fed gets to keep interest rates high and inflation low indefinitely. The math simply does not support it. And as the market slowly realizes that we are heading for a prolonged period of negative real interest rates, the smart money will stop looking at gold and silver as commodities. They will start looking at them as the only remaining exit door in a burning building. The stage is set. The debt is locked in. The inflation is structural. And the real interest rate trap is no longer just a theory you read about in textbooks. It is the dominant force shaping your financial future. And this is exactly why the next move for precious metals isn't just a possibility, it is a mathematical inevitability. If the math behind the real interest rate trap is so clear, why aren't the markets screaming in panic? Why do we still see major stock indices hitting new highs? This is the twist that catches most investors off guard. It creates a dangerous illusion of prosperity that masks a decaying reality. When you look at the stock market today, you are not seeing a reflection of real, inflation-adjusted growth. You are seeing a nominal surge fueled by the very same phenomenon that is destroying your savings. Think of it as a house of mirrors. Because the dollar is losing value, everything priced in dollars, stocks, real estate, commodities, is forced to reprice higher simply to keep pace with the dilution of the currency. If you own a company that is earning 5% more profit, but inflation is running at 7%, you are actually losing purchasing power in real terms. Yet the nominal chart looks green. It looks like success. And this is where the divergence becomes truly treacherous. We can track this perfectly through the data provided by the Federal Reserve. When you overlay real yields against the performance of large-cap assets, you see a widening gap. This is the divergence trap. For years, we were told that as real yields rise, stocks should struggle. But in this current cycle, we have seen asset prices decoupling from economic reality. Why? Because the market has been conditioned to expect a bailout. Investors are betting that the Fed will eventually fold. They are betting that before the system truly breaks, the printing presses will start running again to inflate away the debt. They are not buying companies, they are buying a hedge against the devaluation of the currency. But here's the danger. A hedge built on leverage is not a hedge at all. It is a house of cards. This brings us to the most common argument we hear against gold and silver. You've heard it 1,000 times. Gold doesn't pay a dividend. Gold doesn't produce cash flow. But let's be honest about what that really means. In a world where the currency is being debased, a cash flow is a trap. If your currency loses 5% of its value every single year, a 3% dividend isn't an investment. It is a slow-motion liquidation of your wealth. Vang and silver are not trying to be a stock. They are not trying to be a corporate bond. They are the bedrock upon which the entire financial system was once built, precisely because they do not rely on the promises of a central bank. When you buy gold, you are not seeking a yield in a currency that is destined to fail. You are seeking a store of value that is immune to the fiscal mismanagement of Washington or Brussels. Think about the irony. Investors today are so obsessed with yield that they are ignoring the risk of total capital loss through currency devaluation. They will chase a 4% yield in a high-risk bond, all while ignoring the fact that their principal is being devoured by an 8% cost of living increase. That is not investing. That is a race to the bottom. Gold and silver act as the ultimate insurance policy precisely because they do not produce cash flow. They don't have a counterparty, they don't have a balance sheet that can go bust. In a world of infinite credit and decaying promises, the lack of yield isn't a bug, it is the most important feature. When you look at the market reaction today, you are seeing a massive tug-of-war. On one side, you have the momentum traders betting that the Fed can keep the party going forever by pumping more debt into the system. On the other side, you have the structural reality, a mounting debt crisis that cannot be fixed with the more of the same medicine. The divergence we are seeing between the nominal price of assets and the real purchasing power is reaching a breaking point. We are seeing the cracks in the mirror. When the market finally realizes that nominal gains are an illusion, the scramble for real assets, for gold and for silver, won't just be an investment trend, it will be a stampede. Most people are waiting for a signal. They are waiting for the nightly news or a headline from the Fed to tell them that the environment has changed. But the data doesn't care about headlines. The data shows that the gap between reality and market pricing is now at a historic extreme.
And in finance, when gaps get this wide, they don't close slowly. They snap shut with a violence that catches almost everyone unprepared. You are watching a cycle where investors are holding on to the very assets that are designed to lose value in an inflationary collapse, all while dismissing the only assets that have historically held the line when the currency fails. This is the ultimate contrarian play. And if you understand the divergence, you know exactly why the current consolidation is not a sign of weakness. It is a gathering storm. This brings us to the inevitable conclusion of the real interest rate trap. When negative real rates are sustained for long periods, the market is eventually forced to abandon its pursuit of paper yields and scramble for hard assets. It is not a choice, it is a survival instinct. Think about the future scenario we are staring down. What happens if the Federal Reserve is forced to cut rates, even while inflation remains stubbornly above their 2% target? We are talking about the return of stagflation 2.0. This is the worst-case scenario for the central bank. It is an environment where the economy is stagnant, yet the cost of living continues to climb. In this scenario, the traditional 60-40 portfolio, the bedrock of retirement planning for millions, dies. If stocks are struggling due to a cooling economy and bonds are being decimated by inflation, where does the capital go? It flows into the only assets that do not require a central bank to guarantee their value. It flows into gold. It flows into silver. Investors often mistake this shift for FOMO, the fear of missing out. They look at the gold chart, they see the momentum, and they think people are buying because they want to get rich quick. But that is the wrong lens. If you look deeper into the investor psychology of this cycle, you realize it is not greed, it is the fear of purchasing power loss. It is the gut-level realization that the money you worked your entire life to save is being melted away in a pan of hot inflation. When you see someone buying physical silver today, they are not buying it because they want to see a ticker go up tomorrow. They are buying it because they are terrified that the dollar in their pocket will buy 10% less next year than it does today. And that is a powerful psychological switch. When the motivation for investment changes from seeking gain to protecting reality, the market dynamics shift entirely. You see less selling during price pullbacks because the holder of gold is not holding a speculative asset. They are holding a life raft. We are moving into a regime where the volatility of the past decade will seem mild compared to what is coming. We are seeing a structural breakdown of the global monetary order, and the transition will neither be smooth nor quiet. The central banks are essentially trapped in their own design, forced to choose between the collapse of the currency or the collapse of the debt market. Historically, when central banks are faced with this choice, they choose the currency. They choose to print. They choose to debase. This is why the long-term outlook for precious metals is so aggressive. We are not just talking about a cyclical recovery. We are talking about a structural repricing of the world's most important assets. When the market finally accepts that the Fed has lost its ability to fight inflation, the stampede out of paper and into physical will be historic. But you have to ask yourself, are you waiting for the permission of the market to recognize this reality? Are you waiting for the mainstream to tell you it is safe to act? Because if you are waiting for the headlines to confirm the danger, you are already behind the curve. The real interest rate trap is not a theory for the future. It is the reality of today. It is the hidden force that has been eroding your purchasing power since you opened your first savings account. And while the market continues to obsess over short-term price swings and the next rate announcement, the structural integrity of your currency continues to fail. The implication is clear. In a world where paper promises are being diluted into oblivion, the only assets that will retain their worth are those that cannot be printed at the stroke of a keyboard. The transition is already happening. It is happening in the data. It is happening in the gold vaults of central banks across the globe. And it is happening in the quiet realization of investors who are finally waking up to the fact that they have been trapped in a system designed to fail. The question is no longer whether gold and silver will reach new highs. The question is whether you will be positioned correctly when the rest of the world finally tries to exit the building at the same time. The trap is closing and the exit is narrow. Are you holding the keys, or are you still holding the paper that is leading you into the void? Ultimately, the entire narrative of the gold and silver market comes back to this one invisible force, the real interest rate. It is the silent captain steering your financial ship, even if you never see it on the evening news. While the headlines focus on politics and peripheral noise, the real movement is happening in the math of debasement. If the Federal Reserve continues to keep real interest rates trapped in negative territory, you have to ask yourself the hardest question of all. Is your current strategy of holding cash actually keeping you safe? Or is it slowly ensuring your financial obsolescence over the next 12 months? The era of trusting nominal numbers is over. The era of understanding the real value of your assets has begun. I want to hear your take on this. Do you believe the Fed has any room left to maneuver, or is the trap already locked? Drop a comment below and share your perspective. We are going to continue tracking this data every single week, separating the signal from the noise and giving you the clarity you need to navigate these markets. If you found value in this breakdown and want to stay ahead of the curve, make sure you are subscribed. You now understand the trap. You now see the math behind the curtain. The choice of how you position yourself from here is yours. Take care of your capital, stay vigilant, and I will see you in the next video.